locally, but regionally and against, and of course, provincially and across the country federally. So with that, Joseph, if you, I'll turn my camera off, and if it's okay with you, go ahead and start going through your slide deck, and just go ahead and ask Carly to flip the slides, and we'll save the questions for right around that 25 or 30-minute mark, and then we'll dedicate the last portion to the back and forth, a lot of the conversation with the audience, and then after that wraps up, we want to make sure that we dedicate some time for Jason Smith's area. So I'll do the introduction when it comes time for that, but for now, I'll sign off here from the camera, and Joseph, thank you very much for joining, and please take it away.
Thank you very much, Mike, and good morning, everyone. Thank you for making time for the webinar today and giving me the opportunity to kind of share with you how we're thinking about the global and Canadian economic outlook. To say the least, the last few months have been quite strange with lockdowns and social distancing that we've never really seen before. And it's also been a very tough time for a lot of households and businesses. But I think obviously some of the news is still bad, but the good news is that things look generally like they're starting to return to some sort of normal here. And hopefully all of you and your families are safe and healthy during these challenging times. For the presentation today, I wanted to do a few things, which I summarized on the next slide. We'll start off by taking stock of the economic damage that's been inflicted by the pandemic in the major economies, including Canada. We'll talk about whether governments have done enough to cushion the economy from the impact of the recession, and some of the signs that we're monitoring, which are indicating we're starting to emerge from this severe pandemic-induced recession. And after that, I'll provide a very quick update on the current COVID-19 situation and some of the risks that could undercut the budding economic recovery that is just starting to take hold. And lastly, I'll end with some brief comments on the Canadian dollar and the deglobalization trend before turning over to Jason to wrap things up for us. So for those of you who might have questions, we will have time for Q&A at the end. And with that, we'll get started. So on the next slide, looking at the world economy based on the data from February through May, it's now becoming abundantly clear that this is going to go down as one of the worst global recessions since at least World War II. As a result of some of these unprecedented shutdowns, we've seen affect major economies to suppress this pandemic, something that's never happened before in modern history. This latest global recession is already worse than the financial crisis in terms of severity. And the severity of this damage is really shown on this slide here, with the Canadian and US economies, for example, forecasted to shrink by 7% and 9% respectively this year. With lockdowns being loosened in most major economies, though, we do expect a solid rebound going into next year. And we're starting to see signs of that already for the second half of the year, in which we're starting to see a growth rebound. We'll kind of discuss that in more detail in a bit here. For businesses and consumers, one of the key questions with respect to this economic outlook is whether governments have done enough to counter the recession and help support the eventual recovery. The fiscal policy column here on this table provides the answer to that question. Fiscal measures that have been announced so far not only dwarf even the fiscal stimulus during the financial crisis, but for every major economy, they're also exceeding the size of the estimated economic hit. So if we look at the US and Canadian economies as an example here, these economies will shrink anywhere between 7 to 9% this year. But the Canadian and US governments have responded by delivering spending and aid packages worth roughly 15% of GDP to plug this massive economic hole and then some. So in essence, similar to what the central banks have done, the governments are practicing the same throw the kitchen sink as many times as needed stimulus approach. And even European governments, which have historically been more tight-fisted, have been a lot more aggressive in stimulating their economies than they were 11 years ago during the financial crisis. So on slide number 4, the next slide, staying with the relatively good news for now, while this recession will go down as one of the worst on record, We're also seeing signs that it could also end up being one of the shortest downturns on record, possibly a 2-quarter recession. And this is certainly one of the reasons, for example, why the stock market has rebounded pretty strongly off their late March lows as governments continue to bring their economies back online. The latest data releases for the month of June are indicating that the world economy, as well as Canada, has likely moved past the point of maximum pain. China continues to recover. US and European economies are slowly coming back to life as lockdowns are loosened. You can see this in the top chart, similar to other key economic indicators and purchasing manager surveys and industrial production. This Goldman Sachs current activity leading indicator appears to have bottomed in May. And assuming that there is no severe second wave of infections that triggers the return of heavy-handed lockdowns, and I'll come back to that in a little bit, the global economy appears on track towards a recovery path in the second half of the year, and that'll pick up steam going into 2021. Meanwhile, if we look at the bottom chart on this slide, it shows consumer confidence expectations in Canada and the US have also moved off their nearby lows. And this is a crucial development because household consumption makes up roughly 2/3 of GDP in most of the advanced economies, including in the US and Canada. So on slide 5, next slide, we'll kind of shift our focus to the manufacturing sector. Most of the key manufacturing indicators are also rebounding very nicely from the crash that we saw in March and April. These two charts show the Purchasing Managers Index, which are also known as PMIs, and they essentially survey purchasing managers of manufacturing companies by asking them questions such as whether their businesses are currently growing or contracting, are their inventories accumulating, or are they paring down inventories, and as well as things like delivering times and new orders and stuff like that. And essentially, the 50 level separates expansion from contraction. So that means any reading above 50 means the overall manufacturing sector is growing, and a reading below 50 means business is shrinking. The chart on the left tells us that the global manufacturing sector is still shrinking for now, but we have seen a very strong improvement in the last 2 months, and we expect the global manufacturing sector to return to growth mode in July and August when that data is eventually released. The chart on the right shows the manufacturing indicators for the US, China, and Canada. And the key takeaway here is that the US and Chinese manufacturing sectors are already growing again after falling very sharply in February through April, while the Canadian manufacturing sector is actually not too far behind and is likely to move back into growth territory in the next couple of months as well here, joining the US and China back into growth mode. On the next slide, slide 6, staying with the manufacturing update, the manufacturing indicators that we talked about in the previous slide are forecasting the coming rebound in industrial production. Industrial production data typically lags by a couple of months. So for Canada and the US, the industrial production data we have for now is for the month of May, and June will be published over the coming weeks. And we expect them to show a very substantial improvement based on the uptick in the manufacturing surveys we saw in the previous slide. And if we look at the Chinese industrial production data, which is more timely as we already have data for the month of June, we're encouraged by the sharp rebound we've seen there, which suggests that a recovery in the US and Canadian industrial production should be pretty imminent in the coming months. And part of this recovery in industrial production will be driven by the auto production industry, which was very hard hit by the shutdowns in March and April, as well as the huge drop in vehicle sales in those couple of months. Again, directionally, the level's not good still, but directionally the news is relatively positive for the auto sales. The two charts on the right provide insight into the recent sales trends in the two largest auto markets in the world, the US and China. After dropping very harshly in March and April, US auto sales have bounced off the lows, while the level of sales volumes remains depressed compared to levels before the COVID-19 hit. We do expect pent-up demand amongst potential buyers, as well as lower borrowing costs in the back of lower interest rates, to continue to drive this recovery in auto sales over the next couple of quarters. Moreover, part of this pent-up demand in auto is likely to actually be driven by the pandemic itself as well. For example, we've already seen some automakers attributing part of the sales rebound in May and onwards to consumer preferences now favoring the safety of their own cars versus public transport systems. We've also heard anecdotal evidence of that here in the US and Canada as well. Residents in major cities like New York, San Francisco, and Toronto that maybe never had vehicles before now are either purchasing one or considering purchasing one. So meanwhile, for years, we've heard about the trend towards more urbanization, where ride sharing and vehicle sharing is more convenient than ownership. But if we kind of look ahead, do we kind of see some of that urbanization reverse in the wake of this COVID-19 pandemic? And to the extent that we see some reversal in urbanization as people choose to move to the suburbs, that certainly could increase the need for personal vehicle ownership as well. And if we kind of look at the work from home trend, that's another one that if it sticks after the pandemic has passed, could also lead to greater desire for car ownership. On the next slide, slide 7, shifting gears here, let's talk about the current COVID-19 situation, and that is a risk for the economy. While the economy has clearly been improving of late, we think it's important to still be mindful of some of the lingering risks, including the resurgence we're seeing in COVID in some countries, as well as some uncertainty around secondary effects after this quote-unquote easy part of the recovery, which should at least last through the month of August. On the pandemic front, and again, this is a key risk for the economy. While the situation in Canada is quite healthy, the number of new daily COVID cases globally has recently started to surge again, now averaging well over 180,000 new cases per day. While the good news is that the fatality rates have so far remained relatively stable, these spiking new cases numbers are nonetheless leading to some concerns that some governments may have to reimpose stay-at-home orders, such as in the US, as well as other impacted countries. However, before we get too negative here, our sense is that governments are likely to emphasize the trend in fatalities. And as long as that is stable, governments seem unlikely to implement the types of severe lockdowns in March and April that were so economically destructive. And even if we do see a modest uptick in fatalities, governments are still likely to pursue more targeted and localized lockdowns rather than the blanket lockdowns, given it appears to us anyways that there's not a whole lot of public support for the kind of strict lockdowns that were implemented earlier in the year. And in addition to that, we are also making very good and rapid progress on the medical front with treatments and vaccines, with over 150 vaccine candidates and over 250 treatment candidates in various stages of development over the next few months. We'll continue to get news in this global vaccine and treatment race, and this will continue to be a catalyst, both potentially positive and negative for the economy, depending on the speed of development on this front. So on the next slide, slide 8, a couple of other risks that could undercut the early economic recovery that we're starting to see here, and I wanted to highlight them for you today. With so much stimulus injected into the economy right now, it's very hard at the moment to anticipate the kind of second order effects that might linger on. In the labor market, to give you perhaps the most important example here, it's very hard to forecast with any degree of confidence what portion of the currently temporarily laid off workers will end up in permanent unemployment. And that's really all that matters, is the permanent unemployment will have a more permanent impact on the economy. And if that starts to rise, that could certainly undercut the recovery that we're starting to see here. And the left chart looks at the the number of US unemployed workers on temporary layoff versus those that have lost their jobs permanently. The good news is that a lot of people who are temporarily laid off are now returning to their jobs, which you can see in that sharp downdraft in the blue line. But the bad news is that the rank of permanent unemployment here is just starting to rise, and they could continue to rise as more people find out that some of their jobs that they've been temporarily laid off are not returning to them. This uptick in permanent unemployment poses a potentially significant risk for the economy, and a lot of that will depend on whether or not governments continue to support the economy through income transfers to consumers and households. And the same goes for corporate bankruptcies, which you can see on the right, the chart on the right, which have been pretty tame for now. We have seen an uptick in bankruptcy, but it's nothing compared to what we saw in the financial crisis. But if the economy doesn't rebound quickly, we could see bankruptcies start to pile up potentially next year. All of this suggests that governments, including in Canada and the US, will need to sustain their support for the economy through spending and aid programs, at least until we get some clarity about the economy's ability to stand on its own. So moving on to the next slide, slide number 9, just wanted to touch on the Canadian dollar here, which has depreciated roughly 4% here this year, year to date, falling from 70 cents at the start of the year to about 74 cents as of now. A couple of reasons: weaker commodity prices, particularly oil, concerns around the elevated household debt in Canada and how that might worsen the recession, as well as reliance on foreign investors to fund our budget and current account deficits, have been some of the key reasons behind the looming softness this year. Purely from a fundamental valuation perspective, though, we find the Canadian dollar somewhat, quote unquote, undervalued compared to fair value estimates based on what economists call the purchasing power parity, which factors into considerations such as relative differences in GDP growth, interest rates, and inflation to come up with sort of a fair value estimate for the Canadian dollar versus the US dollar. But in addition to that, if we look at over the past 40, 50 years, on average, the Canadian dollar has traded around the 80 cents level. In fact, over the last 4 decades, the Canadian dollar has spent roughly 70% of the time trading in the range between 70 cents and 90 cents. So we're currently near the lower end of that band at about 74 cents right now. But we look out to 2021, we are essentially expecting the loonie to be reasonably range bound, fluctuating between 71 cents to 74 cents. Perhaps we're anticipating some weakness heading into year end before a rebound, a modest rebound takes hold into 2021. Part of the reason why we believe the Canadian dollar could continue to trade on the cheap side of the fair value estimates, if you recall from our first slide, is that the Canadian economy is expected to do a little bit worse than the US economy both this year and next year. So in terms of the implications for consumers and businesses, although a depreciating Canadian dollar broadly means it's more expensive when we have to travel abroad and buy foreign goods and buy imports, for Canada's export and manufacturing sectors, however, a cheaper Canadian dollar is generally a tailwind. All else equal, a cheaper Canadian dollar, if sustained for a long enough period of time, they help to gradually enhance Canada's export competitiveness against international competitors in global trade, which comes as a tremendous benefit to the Canadian manufacturing sector. Again, we need to see some sustained weakness in the Canadian dollar in order for that competitiveness tailwind to actually come through. And that helps our manufacturing sector because that we have relatively high reliance on the US and other international markets for our products. And the last slide, slide number 10, next slide, this is the last topic for me, and it's about the deglobalization trend we're starting to see here. Globalization historically has occurred in waves. Since the 1940s, though, globalization has generally been the dominant theme in global trade. While it may come as a surprise to some of you, it's worth pointing out that globalization has actually stalled in the past decade. And you can see this on the chart on the slide, which graphs global imports as a percentage of global output measured as GDP. And essentially what this chart shows is that the import to GDP ratio appears to have hit a major top over the last decade or so. And we expect this line to fall further this year. If we look out ahead to the next 5 to 10 years, early signs are that we will see a modest but somewhat uneven pace of deglobalization. Anecdotally, we've heard from many companies in Canada and the US that they are reevaluating their supply chains. And what management teams are particularly focused on in these conversations with analysts is that they are focused on improving the resilience of their supply chains. And typically that involves 2 things. It implies both reducing reliance on a single supplier and country, typically that means China. And in some cases, it also means bringing suppliers closer to the home market. In addition to supply chain considerations, political demands to protect workers and industries are also gaining ground over the last several years, and it's been accelerated by this pandemic. Policymakers in a number of countries, such as the Eurozone, the US and China, and Canada as well, have outlined some policies towards import substitution. Most of the focus here, however, has been understandably focused on healthcare and defense industries, but we wouldn't be surprised if government policies around import substitution and reshoring incentives started to broaden out towards other industries as well. Bottom line here is that details around government policies and reshoring strategies remain fairly limited for now. We've seen a lot of talk, but we haven't seen a lot of concrete policy details. But we're certainly seeing some initial signs that indicate at least some manufacturing supply chain capacity will likely be brought back within national borders. What remains uncertain is the pace and the scale of this forthcoming reshoring trend that's likely to play out over the next 5 to 10 years. So with that, I'll end my comments there, and I'll turn the call over back to Mike and Jason.
Actually, you're going to turn the call back over to Mike and Shelley. Joseph.
Thank you very much.
We're going to open the floor for questions. So did you want to start?
Yeah, not a problem. So Joseph, thank you so much. Really great information there. You touched on a lot of great points. And that's really what we're looking for, is a real sort of an honest approach and a good snapshot of what we're looking at. Both the good, the bad, all together. So look, again, thanks for the presentation. And we saw some of the data on your slide deck with regards to Canada moving back into the growth mode. So looking to that long-term or even the short-term position of our economy as a whole, what are some of the key considerations that our manufacturers could look to prepare themselves over the post-COVID recovery phase?
Yeah, so I mean, in the near term, I think what a lot of manufacturers are very much focused on is ensuring the resilience of their balance sheets. One of the trends that was quite prominent over the last 10 years since the financial crisis is that a lot of companies, including manufacturing companies, have taken on a fair degree of debt on their balance sheets. And what the shock has revealed is that companies have to put a little bit more of their focus on making sure that they're operating at the right debt levels and the right leverage levels. And we've seen a lot of companies go back to their bankers and go back to their finance committees to ensure that they have increased their liquidity through either higher cash holdings or just short-term investments to ensure that they have the flexibility to make it through a recession, as well as if we do see the COVID pandemic linger on. The good news is that we're starting to see revenue stabilization in a lot of manufacturing businesses. And we do expect the manufacturing sector to actually bounce back sooner and in greater scale compared to household consumption. And a lot of that is just because it's much easier to bring your industrial production back online than it is to convince people that it's kind of safe to go back out and start to do their regular shopping again. So the fact that manufacturing revenues are bouncing back sooner than consumption is good news for a lot of manufacturing businesses, but a lot of the focus on the manufacturing side, at least in the near term, is going to be focused on making sure that the balance sheet is in the right shape to make it through the recession, as well as to make sure that they can live through a recession if it does linger on and come back as COVID-19 resurges.
Yeah. So a conservative approach, right? Pretty much everything, right? Weighing everything out, your risks, everything you're doing, you're taking a sort of a more conservative approach to it, right?
Yeah, exactly. Revenue stabilization is great, but we know there's going to be some degree of volatility to that revenue stream, and it's all kind of dependent on how the economic growth rebound scenario plays out. In our base cases, growth have started to rebound, but there is still some risk that could undercut that recovery, and that makes managing the balance sheet and making sure resilience on the balance sheet is all the more important over the next 6 to 12 months.
Yeah, makes perfect sense. Yeah.
We have a
Shelley?
question from a couple of our participants, so I'm going to jump in with one of them right now. And it's something that down in the Windsor-Essex region, we pay very close attention to this, and it is the ability to cross the border into the US and then back into Canada. So the question is, how will the prolonged US-Canada border closure impact the Canadian economy? What are your thoughts on that, Joseph?
Well, I think most of the, it's kind of twofold. So obviously the border restrictions are not great for things like the tourism industry, but for the most part, these border restrictions have made general exceptions for the transfer of goods and products and services across borders. So I think for manufacturing businesses, that is a risk. If they do have to shut down the border in a more comprehensive way, that could negatively impact the Canadian economy, for sure. But for now, it seems like the government's very much focused on the people element in terms of border restrictions, and for good reasons. Given what we're seeing in terms of the COVID developments in the US, I think they do have to be somewhat more conservative and careful in managing the border restrictions for individuals that are traveling between the two countries. But for goods and services, the transfer of those across borders have been not nearly impacted to that same extent, and we continue to expect that to be the case for the Canadian government policy. So for manufacturing businesses, it's an issue, but it's not as problematic as it is for something like the tourism industry.
Mm-hmm. Yes, absolutely.
Oh, good question.
Okay. Mike?
Yeah, I've got another one here that's come in. So the question is, what global market regions would regain most likely resurgence in global trade in the wake of moving away from trading with China? So I guess to rephrase that is, I guess the question would be, what jurisdictions are going to benefit most out of obviously reshoring into Canada, but what other regions on the globe would be of benefit to this? And I hope I'm getting that correctly.
Yeah, so I mean, that I'm not sure which direction of trade we're talking about here, but in terms of trade diversification, let's be honest, the Chinese market is very hard to replace. It is the largest, or quickly becoming the largest consumption market globally. So replacing the biggest market for consumption globally is always going to present its own challenges. So I think rather than replacing China in terms of Canada's trade diversification, there are two other areas that make a lot of sense. So certainly the new trade deal with the Eurozone in particular, opens up a brand new market for Canadian manufacturers. The rejigged USMCA certainly allows access to the US market pretty much in the same way as it did before, because there wasn't all that much that was changed. It was just, the name changed, that's for sure, and a few other domestic content rules were changed as well. But beyond that, the deal looks mostly the same as it was before, and that means we continue to have access to the biggest economy in the world in the US. But beyond the Eurozone and North America in general, Southeast Asia economies like the Philippines, Vietnam, as well as Taiwan, South Korea, these are other countries that could benefit relatively from reshoring as well, at least from the perspective of supply chain diversification. If countries are looking to diversify their sole supplier from China into other areas, in addition to bringing them back to Canada, they could also consider other South Asian countries that have pretty good infrastructure that allows for expansion of supply chains in a relatively quick order. And that includes countries like Vietnam, Philippines, Taiwan, as well as South Korea in that Southeast Asian region. So those are some of the key regions that could benefit. South America is another one, but given their economies are likely to underperform, given how bad COVID is going on there, they're unlikely to provide a benefit at least in the near term. Beyond that, I think that's also an area where you have a rising middle class, and that could develop into a pretty substantial consumption market, allowing for access into a pretty large sales market for Canadian manufacturers over time. But in the near term, it's still, South America is still a very challenged situation.
Right. Yeah, and all the discussions and all the data that you've been reviewing over the last couple of months, that really all points to that, right?
Yeah,
I mean,
exactly.
Overwhelmingly, yeah. Okay. Shelley, do you have one on deck?
Yep. So you had a slide that touched on Canada US currency exchange rate forecasting. And you mentioned one of the impacts in that, one of the factors that impacts it is foreign investment. So, you know, what would you say is the climate right now for foreign investment into Canada? I'm assuming that would be the major impact on the Canadian dollar.
Yeah, so I'm going to separate that into foreign investment in Canada in the resource sector, and then foreign investment in Canada outside of the resource sector. I think the resource sector is pretty clean narrative there. That foreign investors are not interested in investing in Canadian resource sectors, whether that's energy or mining, for a number of reasons. That's not a new trend. That trend has been ongoing, going back the last 5-6 years since the last oil crash in 2015-16. A lot of that just has to do with a government policy stance that's pretty, that's not conducive to a lot of infrastructure development, whether that means pipelines or mine approvals. So anything on the resource side, there's not a whole lot of appetite of international investors looking to invest in Canada. However, when we look outside of Canada, whether that's auto or technology or other industrial production facilities in general, we've actually seen an improvement in climate in terms of Canadian competitiveness. And a lot of that has to do with the depreciation of the Canadian dollars. For those of us that still remember the Canadian dollar trading above par versus the US dollar, that was an incredibly bad headwind for the Canadian manufacturing sector, because it erodes our competitiveness of our products and services, whatever we're exporting globally, compared to our international competitors. But over the last 4 or 5 years, we've seen a sustained weakness in the Canadian dollar, and that's helped restore a lot of our export competitiveness, as well as our labor costs as well. And as a result of that sustained weakness in the Canadian dollar, we've seen improvement in manufacturing facilities in Canada, not just in auto, but also in other areas, pick up over the last few years. Going forward, our view is that certainly the Bank of Canada doesn't want to see a stronger dollar. I'm pretty sure the Canadian government doesn't really want to see too much strength in the Canadian dollar. And as long as we get some sustained weakness in the Canadian dollar, that will continue to be a benefit to the Canadian manufacturing in general, and that will continue to help attract capital back into Canada for investment, at least in sectors outside of resources.
Mm-hmm. Okay, that makes a lot of sense. And you know, we all hate to see rapid swings in the currency, and I mean, your projection has it relatively stable, which is good to see. Mike, you had a question.
Yeah, I've got another one here. The question is, with respect to the new USMCA, what impact does the agreement have on our manufacturing sector from a high-level economic viewpoint and our relationship with our trading partners?
At a high level, it's great because it removes a massive uncertainty that existed for, I think, well over a year while negotiations were going on. And the fact that, and there's, I think, a couple of key takeaways from the revamp. For the most part, again, it looks pretty much like the old NAFTA, not much change. And some of the key changes included a higher domestic content within North America for the auto sector. And that certainly helps Canada for sure.
Sure. Yeah. Yeah.
In addition to that, we've also seen them toughen up some of the regulatory frameworks about compliance to ensure that these higher content, domestic content rules are enforced and are adhered to by manufacturing companies. So I think generally speaking, when we look at some of the key changes that were made, and the fact that most of the agreement looks pretty much like the old one, helps remove the uncertainty of the fact that, you know, we've replaced it for at least the next few years, and we don't need to worry about our trade agreement, at least within the North American borders. And overall, that certainty brings some degree of confidence back into the, at least investment in the Canadian manufacturing sector, for sure.
Yeah, makes perfect sense. Shelley, I think we have another?
Yes, yeah. So you mentioned about reshoring and that, you know, there are government policies currently in place to support it in the fields of, I believe it was healthcare and defense. And you said that there is a likelihood that policy could be crafted to support it for the manufacturing sector. And when you look at it from an economic perspective, what kind of role does the manufacturing sector play within the Canadian economy? What kind of importance do we play? And, you know, what are your thoughts around policy that could support reshoring?
Well, manufacturing sector remains a key input in the Canadian economy. Its importance has somewhat waned over the years because we've seen a pretty consistent trend of offshoring, call it over the last 30 years. But a number of things have changed at the margin. Labor costs globally have become more equalized, and that certainly reduces incentives for offshoring. We do see a case for some of the policies around reshoring incentives to broaden out. And that's simply because there's domestic political demands that are driving that trend. But on top of that, we also know companies, in speaking with them, our analysts have pointed out that a lot of companies are now looking to diversify their supply chains. And one of the most effective ways of doing that is not just moving to another low-cost country, is just bring them back closer to home. And so far, again, they've focused on some of the key product categories in healthcare and defense industries. But over time, these incentives also make sense for Canadian manufacturers more broadly because other countries are doing that. And it wouldn't be fair for the Canadian manufacturing sector to not have similar types of government support. We have to understand that if we look at China and other lower cost production countries, their governments have been extremely aggressive and proactive in providing incentives for the manufacturing sector. And to some extent, North American governments, Canada and the US obviously, have not matched those kinds of incentives of reshoring, or at least bringing back production.
Oh, goodness.
The intensity and urgency of other countries. So we would love to see that. And it's something that I think through a lot of different organizations, they've certainly expressed an interest to work with the government to come up with more policies and to refine these incentives for the manufacturing sectors. And we look forward to the details. Unfortunately, right now, we just don't have a ton of details around that. And to the extent that they can provide details around those policies, we can certainly have a more detailed discussion around how they might positively impact the Canadian manufacturers. But at a high level, we should start to see policy shifts towards reshoring to broaden out towards other areas such as auto as well as other industries.
Yeah. So, so if I can jump on that response, and thanks for the answer. Is there any? I know we don't have the details, and you just made mention of that, but are there any examples of other types of incentive models that are being used elsewhere outside of manufacturing as a standalone? But any evidence or any examples that you could give us and share a little insight to some success stories about what's happened over in the past and what's worked and what's not?
Yeah, so there's there are two types of incentives that have done a lot of heavy lifting in other countries' policies. The first type is providing low-cost loans, availability to manufacturers that want to set up facilities within their own countries, and sometimes these loans are actually interest-free. So as long as they're paid back, you don't actually pay interest in them. So some type of low-cost financing incentives, maybe interest-free loans from the government, would be hugely favorable in terms of policy incentives. The other types of policy is just on the tax front. A number of countries provide very favorable tax treatments to allow faster depreciation of capital expenditures. So if you're spending $100 million to build out a manufacturing facility, some of these countries have allowed for all of that to be depreciated on the cost side of the expense in the first couple of years, rather than having that play out over a longer period of time. And a faster and a more aggressive cost depreciation tax breaks for these companies to have manufacturing facilities that helps to equalize the production costs for a lot of manufacturing industry, manufacturing sectors and goods as well. So those are the two types. Tax breaks as well as low-cost financing have been very effective policy instruments for in terms of their role as policy incentives to bring back manufacturing jobs.
Excellent. Oh, thank you so much for that, Joseph. Shelley, I'm looking in the chat. And I think some of the questions are sort of regurgitated to what we've already seen. I think at this point, did you have anything else, Shelley, from your end that you'd like to request?
No, I think we've covered all of the questions, and we've got about 14 minutes left out of our time block. I don't think anyone will complain if we end a little bit early, but I know you've got one more person on our agenda today.
Yes, yeah, that's right. So Joseph, thank you so much once again from on behalf of Automate Canada and CAM, and I know our audience, I'm sure, took a lot of information in and took have a lot of great takeaways from what you've put out for us. We're going to shift gears a little bit, and if you could, Joseph, please hang on and stay on with us while we shift over to Jason Smith. Jason Smith, here locally in Windsor, Ontario, is a wealth advisor for RBC, and he's got a few slides that he'd like to present to us. So with that in mind, I will pass things over to Jason. Are you with us, Jason? Jason, I think you're on mute.
You are correct. I think I was on mute.
Oh, there you are. Okay, so I'll turn off my video and yeah, feel free to take over, and thank you again.
Thank you, Shelley. Thank you, Mike. You guys are terrific, and I'm so thrilled that we could provide Joseph for your conversation today. As many businesses are queuing in to listen to Joseph today, I'd also like to put a human side on that. As much as your corporations are worried about their future, I'd like to put in a little plug for your employees, as they are also concerned about their future. One of the things we see in our business is a lot of employees worried financially. This is very difficult on them. And most of them in their group plans end up going to basically 1-800 numbers. So I'm inserting a little promo here for the Royal Bank Group Advantage Services. The key strategy is to actually make sure that every one of your employees has access to a person who can give advice and is a financial planner. The 800 numbers will usually do whatever the person needs to do. However, walking into a bank and discussing, instead of just, you can go to the next slide, instead of just dealing with their RSPs, etc., when they walk into any Royal Bank, they can sit down, talk about their planning, talk about not just the RSPs, but talk about their TFSAs, you know, their children's education, the difficulties with credit cards, full service counseling. Financial wellness is our business. and nothing beats a person-to-person meeting. I think if you could upgrade a machine with the touch of a button that made all your employees more effective, you wouldn't hesitate to. I think this, if anyone's interested, we'd be happy to talk further about it, but I think RBC, and by the way, this is not a Dominion Securities product, I'm just happy to represent it to CAM, as I feel it's a premium solution. RBC Group Advantage can give your employees a one-on-one experience to look after the full of their financial life. I think that's the next slide, if we could. So again, the holistic advice, obviously education to make sure people understand what's going on, and just more than they're used to. When your employees are cared for, the number one stressor in life is often financial. This may lighten up the load on them and allow them to be more effective with you. So if that's my singing for the supper, I apologize that my Zoom didn't connect as cleanly and you can't see me, but I thank you very much for giving me the opportunity to speak.
No problem, Jason. Thank you so much. I won't take any more time on my end. I'm going to pass things over now to Shelley, who can take us out. Shelley?
That's great. I get to close us today. So Carly, thank you. I was just going to ask her to pop up the promo slide for our next webinar. But before I go to that, again, a great big thank you to Jason Smith and Joseph Wu from RBC Dominion Securities. Jason is one of the sponsors of CAM, and we appreciate his support and help in coordinating today. Joseph, it was fascinating. I was writing all kinds of notes here, and I really appreciate sharing your expertise and doing so, you know, not just in a presentation, but also answering the questions that we were throwing at you. So, you know, the unfortunate thing in a Zoom is you can't hear everyone applaud you, but imagine there is applause, and we really appreciate your participation today. So thank you.
Thank you. My pleasure.
Yeah. We do, so hopefully in the near future, you'll be able to come down and experience Windsor Essex as well. We do have a webinar coming up on July 29th. So, you know, we coordinate all of our webinars because of information that's communicated to us through our surveys. And so respondents have told us, among other things, they've told us that their concern about the economy has been top of mind. And so we got you some very good information today from the experts at RBC Dominion Securities. On July 29th, another hot topic for everyone, it was actually brought up today, are the issues that are being experienced going back and forth across the border. So our goal with the July 29th webinar, with the support of the Windsor Essex Economic Development Corporation, will have Canada Border Services Agency representative with us on the 29th to answer questions. They are going to explain to us what is needed to safely cross the border for business travelers, both entering the US as well as returning to Canada, what some safe practices are to follow in order to avoid being required to quarantine, and what kind of authority we can expect to experience at the ports of entry. And the ports of entry in Windsor Essex are the Ambassador Bridge and the Detroit-Windsor Tunnel. There have been lots of questions over the past few weeks, and so CBSA, Canada Border Services Agency, is aware of the questions that we've been receiving and will be prepared to address them in their presentation, and as well answer questions. So please, everyone, I hope you can set aside the time in your schedules to join us on July 29th. And with that, I think we can officially draw today's session to a close. Thank you, everyone. Thank you, as always, to our incredible behind-the-scenes technical wizard, Carly Deslip, for making sure that things go off without a hitch every time we host a webinar. So thank you, everyone.
Thank you, everyone. Enjoy the rest of your day.